Have you ever looked at your credit card statement and wondered, wait, how did I end up owing this much? Well, you're not alone. Today, we're going to unpack the fascinating world of credit card interest. Buckle up because by the end of this video, you'll have a clear understanding of how it works and how to keep your finances in check. So, what exactly is credit card interest? Simply put, it's the fee that credit card companies charge you for borrowing money. When you make a purchase using your credit card, you're essentially taking out a loan. If you don't pay off that loan in full by the due date, interest kicks in. This can lead to a snowball effect if you're not careful. The longer you carry a balance, the more interest you'll rack up. Now, let's get into the nitty-gritty of how this interest is calculated. Credit card companies often use something called the annual percentage rate, or APR. This is the yearly interest rate that determines how much you'll pay in interest on your balance. But here's the catch. They usually calculate this interest on a daily basis. Yes, that's right. They take your APR, divide it by 365 days, and charge you interest daily based on your balance. For instance, if your APR is 18% and your balance is $1,000, the daily interest would be roughly 49 cents. If you don't pay off that balance, it adds up quickly. So, if you wait a month to pay, you could be looking at about $15 in interest alone. Yikes, not all interest rates are created equal. Some cards offer promotional rates that can be lower to entice you to sign up. These are often called introductory rates. However, be aware that these rates usually increase after a set period. Then, there are fixed rates which stay the same and variable rates which can change based on market conditions. Knowing which type you have can make a big difference in how much you pay over time. Let's talk about minimum payments. They might seem like a lifesaver, but they can be a trap. When you only pay the minimum, you're barely scratching the surface of your balance. Most of your payment goes toward the interest, meaning you could be in debt for a long time. If possible, aim to pay more than the minimum each month. This will help you pay off your debt faster and save you money on interest. So, how can you avoid high interest charges? Here are some tips. First, try to pay your balance in full every month. If that's not feasible, consider transferring your balance to a card with a lower interest rate. Just be cautious of fees associated with balance transfers. Another option is to create a budget to keep your spending in check. This way, you won't find yourself in a situation where you can't pay your balance. Don't forget about the importance of making payments on time. Late payments can lead to increased interest rates and even damage your credit score. Setting up reminders or automatic payments can help you stay on track. Trust me, your future self will thank you.